According to Raymond James Chief Investment Officer Larry Adam, equity markets experienced a post-election rally with the S&P 500 crossing 6,000 for the first time on November 11th and finishing the month up 5.7%. The S&P 500 and the Dow Jones each saw 4 all-time highs in November alone, driven by the market's belief that the incoming administration's economic agenda is pro-growth. A post-election bounce is not unusual because the market likes clarity. However, be careful not to extrapolate the recent gains, as the market will increasingly focus on the fundamentals. In equities, small companies were the big story as small cap stocks outperformed large caps. Smaller companies are seen as more reliant on adjustable rate borrowing, so the rally could be attributed to the Federal Reserve's cuts to the baseline interest rate. Small caps were likely further aided by the expectation that the incoming administration's deregulatory theme will benefit the heavily weighted financial sector. Donald Trump's victory, combined with Republicans taking control of the Senate and retaining control of the House, strengthens his mandate and ability to enact his policy priorities. With announcements of key personnel throughout the month offering a preview of likely agenda items, the slim House majority could complicate the path forward. However, especially around fiscal negotiations, volatility around state and local tax deductions, the fate of the 2022 Inflation Reduction Act, and the use of tariffs to offset tax cut extensions will be factors to watch. Small caps, banks, industrials, and consumer discretionary stocks rose sharply last month as the biggest election beneficiaries. Interest-sensitive and tariff-exposed areas lagged, as did clean energy. Reactionary momentum may persist for weeks to come, but markets tend to move fast in one direction before reality plays out. Uncertainties surrounding the economy and inflation could create volatility. Treasury yields moved in extremes during November, with the 10-year reaching as high as 4.44% and dipping as low as 4.26%. Yields began moving up ahead of the election, each week building on the momentum from the last throughout the month. The selection of Scott Bessent, a Wall Street veteran, as Secretary of Treasury proved popular and the market rallied, bringing yields 10-plus basis points lower across the curve. Employment data varied with the source. The establishment survey indicated employment was almost unchanged during October, while the household survey showed a large loss of jobs, and the survey of small businesses by the human resources firm ADP showed a large increase in jobs. The labor strike and hurricanes may have temporarily distorted employment readings, so the upcoming November jobs report should provide additional clarity. The Consumer Price Index was in line with expectations during October, up 0.2%, while the core CPI was up 0.3%. With increased shelter costs preventing the index from slowing year over year, October retail sales, meanwhile, beat expectations, and September results were revised higher from early estimates. The election results signal increased growth potential, but when you add Fed easing and market all-time highs to the mix, the chances of inflation rearing its head again also increase. Investors will remain sensitive to the monthly data, and we've seen sentiment and positioning shift rapidly, creating volatility. It's helpful to remember that while politics can drive headlines, fundamentals drive the market longer term. And that's all for this month's Market Recap. If you or your family have any questions, please don't hesitate to reach out anytime. And as always, thank you for watching and have a blessed day.